Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Stock Market Crashes, Lessons from History. The stock market can be a roller coaster, and crashes are its most dramatic drops. These events can shake economies and shatter investor confidence in an instant. But amid the chaos, there are crucial lessons to be learned from past crashes. By studying these historical events, we can better understand how to navigate the risks and avoid making the same mistakes. This video will explore significant stock market crashes, what caused them, and how investors can apply these lessons today. Ready to turn panic into opportunity? Let's get started. Understanding stock market crashes. When we talk about stock market crashes, we're diving into a world where financial stability can shift in the blink of an eye. This section will help clarify what exactly constitutes a stock market crash and what typically causes these dramatic downturns. Definition and characteristics. A stock market crash occurs when there's a sudden and significant decline in the value of stocks across major sectors. Imagine the stock market as a towering building. A crash is like the foundation giving way, causing the whole structure to collapse. Key characteristics of a stock market crash include rapid decline. Stock prices plummet at an alarming rate. This often happens in just a few days or weeks. Panic selling. Investors, gripped by fear, rush to sell their stocks, which only worsens the situation. Market volatility. Prices swing wildly, making it challenging to predict any stable movement. Common causes. Several factors can trigger a stock market crash. It's like a perfect storm where different elements come together to create chaos. Here are some common causes. Economic factors. Recession fears. When the economy slows down, companies earn less, and their stock prices drop. High interest rates. Rising rates can make borrowing more expensive, weakening business growth and reducing consumer spending. Inflation. High inflation reduces the purchasing power, leading investors to fear lower future earnings. Speculative bubbles. Overvaluation. Sometimes stocks get hyped beyond their true value. Think of it like blowing up a balloon until it bursts. Excessive optimism. When investors become overly confident, they may invest blindly, driving prices unrealistically high. External shocks. Geopolitical events, wars, political instability, and other global issues can shake investors' confidence. Natural disasters. Events like earthquakes or hurricanes can disrupt economies. Pandemics. Health crises, as seen with COVID-19, can lead to massive economic slowdown and crash the markets. Understanding these causes can help investors anticipate potential crashes and make more informed decisions. In the next sections, we'll explore historical examples to see these elements in action and learn valuable lessons to apply today. Case studies of historical stock market crashes. Understanding past stock market crashes can help us navigate future financial challenges. Let's dive into some of the most significant crashes and the lessons learned from each. The Great Depression, 1929. The stock market crash of 1929 marked the start of the Great Depression. Why did this happen? A mix of speculative investments and easy credit was a big cause. People were buying stocks with borrowed money, hoping to get rich quickly. But when stock prices started falling in October 1929, panic set in. Events unfolded with Black Thursday, on October 24, when the market lost 11% at the opening bell. Panic selling continued into Black Monday and Black Tuesday, leading to a 25% drop in 2 days. It wasn't just a stock market event, it was a financial earthquake that led to bank failures, high unemployment, and widespread poverty. What did we learn? The crash taught us about the dangers of speculative bubbles and the need for regulation. The introduction of the Securities Act of 1933 and the Securities Exchange Act of 1934 aimed to bring order and transparency to the markets. Black Monday, 1987. Black Monday on October 19, 1987, saw the Dow Jones Industrial Average plummet by 22% in a single day. This crash didn't have a single driver but was caused by a combination of factors, including high stock valuations, computerized trading, and foreign exchange instability. Why did it happen? Automated trading systems, or program trading, were selling large blocks of stocks when prices started falling, magnifying the drop. Additionally, there was no central oversight to halt the trading frenzy. What was the aftermath? The market recovered relatively quickly, with the Dow regaining most of its losses within the year. However, it led to significant changes in stock market regulations. Circuit breakers were introduced, which are measures that pause trading if a severe drop happens, giving investors time to think rather than react in panic. Dot-com bubble, 2000. The late 1990s saw a boom in technology stocks, especially internet companies. Investors poured money into new tech ventures, driving stock prices to astronomical levels. But many of these companies had no profits to show, just promises. What triggered the burst? By March 2000, investors started realizing that most of these companies were overvalued. Confidence waned, and the Nasdaq, full of tech stocks, fell by nearly 78% by October 2002. Impact on investors? Many lost fortunes, and it took years for the market to heal. This era taught us the importance of due diligence. Just because everyone else is buying doesn't mean it's a good idea. Always research and understand the fundamentals of what you're investing in. Global financial crisis, 2008. The 2008 financial crisis, also known as the Great Recession, was triggered by the collapse of the housing bubble in the United States. Banks were doling out loans to people with poor credit, subprime mortgages, packaging these risky loans into supposedly safe investments, and selling them globally. What went wrong? When people defaulted on their loans, the whole system unraveled. Big banks failed, mortgage-backed securities plummeted, and the stock market crashed. The Dow Jones lost over 50% between 2007 and 2009. What came out of it? Massive government bailouts and the Dodd-Frank Act were efforts to stabilize and reform the financial system. Banks are now required to maintain better capital reserves, and there's more scrutiny on risky lending practices. COVID-19 pandemic crash, 2020. The COVID-19 pandemic brought a swift and unexpected economic downturn. As countries went into lockdown, businesses shuttered, and millions lost their jobs. The stock market reacted sharply, with the S&P 500 dropping by about 34% in March 2020. How did it unfold? Fear and uncertainty led to mass selling. However, unprecedented government stimulus and rapid adaptation by businesses, like shifting to online models, helped markets bounce back quickly. Lessons learned? This incident highlighted the importance of diversification and having a long-term investment strategy. Markets can be incredibly resilient, and staying the course during downturns can pay off in the end. By studying these historical crashes, we can see the importance of regulation, diversification, and understanding market fundamentals. These lessons help us prepare for future challenges and may even turn potential panic into opportunity. Lessons learned from historical crashes. Stock market crashes may feel like the end of the world, but they offer invaluable lessons. By examining past crashes, we can better protect our investments and build a more stable financial future. Importance of diversification. One crucial takeaway from past market crashes is the importance of diversification. Think of your investment portfolio like a garden. If you only plant one type of flower, a single pest can ruin everything. But if you have a variety of plants, the impact of a single pest is minimized. Why diversify? Reduces risk. By spreading investments across different sectors, asset classes, and geographical regions, you're less likely to suffer a total loss. Stable returns. Diversified portfolios often have more consistent performance. While some investments may underperform, others can offset the loss. Financial safety net. During downturns, diversified portfolios are less likely to see extreme drops, providing a cushion against panic selling. Regulatory reforms. Regulatory reforms play a pivotal role in preventing future crashes and protecting investors. Just like traffic laws keep drivers safe, financial regulations aim to maintain market stability. Historical impact. Post-Great Depression reforms. After the 1929 crash, the Securities Act of 1933 and the Securities Exchange Act of 1934 were implemented. These laws increased transparency and reduced fraudulent activities. Financial crisis 2008. The Dodd-Frank Act was introduced to prevent another collapse like the one in 2008. It increased regulations on banks and financial institutions, ensuring they maintain adequate capital and disclose their risks. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.